All right, here we are again. So, all right, let me get everything open. We were part of the way through chapter 11, I believe. And let's see, let me just confirm that. Yes, 11, stock valuation and risk. Today's the 20th. And when this is done, we can jump ahead to 13, which is forwards and futures. Okay, now one thing I need to note here is that I was kind of surprised when I was looking at the syllabus and my calendar, because I don't think this has ever happened before, but oh, hold on one second. Let me see if I have to save this. All right, so yeah, if you look at our syllabus, let me quickly go find it. There we go. I seem to remember that we always had 10 weeks during the summer. So either I'm just completely imagining things, or else maybe they just change it on us. But according to what I saw on WebAdvisor, our last meeting, in fact, let's go get it. Okay. Yeah, according to this, the last night is the 27th. That's next week. So this tonight is the 8th time we've met. And so what that means is that, unlike what I originally believed, where it looks like we're only having 9 classes instead of 10. So that means we have to make a change to what we're doing here. Now, we already have had a few problem sets, which I will go show you in Blackboard. Let me go find that real fast. I seem to remember we agreed that 3, 7, and 8 would be the appropriate ones. So I'm just going to open up Blackboard real fast. There it is. All right, so if you look at the course readings, we have a midterm. Now, I think that was meant to be due next week. That sounds about right. I can confirm that later on. Not tonight, that's for sure. And then we had problem sets available for weeks 3. Yes. And I think 7 and 8 were the other 2. There's 7 and there's 8. Oh, wait, sir, where's 8? No, here we go. Yes. No. Oh, yes, there it is. It's way down at the bottom. Let's get that up here. Anyway, so here's what I think we're going to have to do. So we can finish the stock market discussion tonight. We can do a large amount of the discussion about forwards and futures. And then the next week, we would be doing options. The last week, which we're not going to have now, would have been swaps, which in my opinion, is the least important of those 3 topics. So here's what I think we're going to have to do. If our last night is the 27th, which is a Tuesday, they normally give us 3 business days to have all the grades ready, which would make it the following Monday. Monday, the 2nd of August. So I think what we're going to have to do is, instead of having a final exam, we'll just have to have a spreadsheet project, which will be based on our discussion about forwards and futures. and which you can do in Excel, and it will be, I'll make sure that it's not so long that you can't finish it. That would mean we'd have to have it ready by Monday, August the 2nd. Okay, so because I misjudged how much time we have left, I think that would be our best bet. So here's what I'm going to do. Let me go into the announcements right now and put them there. Ooh, don't have a lot of announcements, do I? No. That's because everyone comes to class. I like that. So wrapping things up. Let's call it wrapping things up. So hello, everyone. In case you weren't here tonight, it appears that our last session will actually be next Tuesday, 7/27. As a result, there will be no time for a final exam or a normal final exam. Okay, so here's what we'll do. The problem sets from chapters 3, 7, and 8, and the midterm will be due on the 27th. Okay. The final exam will be replaced with a spreadsheet project and will not be very long. Okay, just enough to cover the material based on our discussion of chapter 13, futures and forwards, and chapter 14, which is options. It will be due. Let's see, let's think about this. You know what they've done to me in the past? If the grades are due on Monday the 2nd, they might be due in the early morning, like at midnight, noon, or something like that. Sorry. So I'll tell you what. Let's do this. Let's do this Sunday evening, August the 1st, and then if I can give you more time, I will let you know immediately. So that way, let's consider it to be due on the 1st, but with the potential for my being able to give you another day or so. That I have to find out with the school. So anyway, so therefore, well, so next week we will wrap up chapter 14, because I assume that we'll be done with both 11 and 13 tonight. And then there will be no new material. Okay, so I think that should suffice. All right, so in other words, the 3 problem sets plus the midterm, which have already been assigned, you can hand them in next Tuesday, so I can grade them. And then the spreadsheet final will be due the following, let's say, Sunday night. What I'll probably do, I know what I can put in here. Even though we haven't started discussing options yet, chapter 14 is on Blackboard. I will post the project over the next couple of days. In case you want to start early. All right, so in other words, I'm not going to make you wait till next week. I'll put it up there, and if you feel like looking at the chapter, now you'll see when you get to this project that a fair amount of it actually involves graphs. Okay, I'm trying to avoid a lot of math on this final. And the graphs are pretty straightforward. I think you'll agree. These graphs involve option strategies. So that way, I want to make sure you don't run out of time. We don't want to get too involved. There is some math in chapter 14, but we don't have to actually have it on the final exam. Instead, we can focus more on the features of options, where we can analyze them very nicely, as you'll see, with graphs. and not just always math. Okay. So anyway, what I'm trying to do is make this as painless as possible, a wrap up of the semester. We've gotten a lot done here, but man, the time really slipped away, didn't it? And especially because I really thought next week, I thought we had 10 sessions and now we don't. So I guess, well, we still got a lot done. So that's the bottom line. So anyway, that I think that says everything we need to know. So, all right. In the meantime, let's get back to it. Where's the send button? There it is. All right, I think that is self-explanatory. So, and of course, if you still don't understand, you can send me emails. So let's just get back to work here. Let's get back to our slides. So 11 rather is the one we were in the middle of. I think we left off. We were about to start the capital asset pricing model. All right, let's do that. And then we'll go through the forwards and futures. If there's any time, maybe we'll take a quick peek at the options chapter, just so you can get a feel for where we're going. But again, the options chapter lends itself very nicely to Excel, which I think you'll all be happy to hear about. I assume that since you all work in the real world, that you have some exposure to Excel. You don't have to be an expert, as long as you can copy formulas into it and use some basic graphs, you'll be fine. Now, and when I teach finance in the daytime to the undergraduates, I frequently try to encourage them to learn Excel as much or as soon as possible. I don't know how much impact I'm having with that, but I think you'll all agree that Excel is critically important in the job market, isn't it? Yes, it is. Okay. So, all right. Anyway, so now remember, the whole purpose of this chapter is to understand models that help us understand the pricing of stocks. And with the capital asset pricing model, we're developing a framework to help us understand how risk is determined and how that relates to rates of return. So we're not really pricing stocks so much as trying to understand the relationship between risk and return in the stock market. So the CAPM model is the theory of security returns. It was developed in the early 60s by a group of researchers, and eventually they were awarded the Nobel Prize for their efforts. So that shows you how important this turned out to be. Now, the CAPM model, like any other model, has its problems. It's based on assumptions that may or may not be realistic, but it's very heavily used in many different applications. In fact, just to show you how important it is, let me go show you, just for a second, finance.yahoo.com. Now, the capital asset pricing model develops and introduces its own unique measure of risk, which is called beta. And you may have heard of that before, but you might not have known how it was developed or what does it mean. So if you go here and look at any stock, let's say with Apple, right off the bat, one of the first things they tell you is the beta of the stock right there. That's how important this is to of course, the creators of this website. They want you to see right off the bat the beta of the stock, which is 1.21. Now, we'll eventually explain what that means, but it does give us some sense of how important this measure is in the stock market. Okay, so yeah, and while you're at it, you can look at all the wonderful statistics about Apple and all the rest of this information. You can download historical prices. You can do all kinds of wonderful research. But for now, I just wanted you to see the beta measure, which is listed right here on yahoo.finance.com. Anyway, what this basically is telling us is that if stocks are undervalued or underpriced by investors, investors will figure this out fairly quickly. They will buy those stocks and push their prices back up to a more a level that is consistent with the risk contained in the stock. The stocks that are overpriced or too expensive will be sold by investors, which will push their prices back down to a level which is consistent with their risk. So according to this model, this will happen automatically on a regular basis. In other words, they're saying that if stock prices are, let's say, too high or too low, they won't stay that way for very long. Okay, so what is this model all about? Now, the developers of the model decided to create their own measure of risk, which I've already mentioned is beta. And the beta itself is a measure of how closely our stock is related to what we will call the market portfolio. Now, what exactly is the market portfolio? Well, it's a fictional portfolio that doesn't really exist, where it contains all the assets in the economy, and the weights that are attached to each of these assets are determined by their market capitalization. Now, at the bottom here, I've got a little reminder. Market capitalization is the dollar value of the company's, all the company's outstanding shares of stock. So while we've got Apple open here, we may as well take a look at it and see what their market capitalization is. And I think you'll be shocked to see, maybe not, that right now their market capitalization is $2.439 trillion. So that if somebody felt so inclined to buy back every single one of those shares, it would cost $2.439 trillion. That is the largest market cap in the country right now, in the world. Nobody else has that much market cap, although there's some that are coming close, like Amazon, as you can probably imagine, is also going to have a large market cap, about $1.8 trillion. Which, by the way, I don't know if you saw these pictures today. Speaking of Amazon, does anyone know why Amazon is in the news today? I mean, they're always in the news, but because, let's see, where's that picture? Oh, come on. No, that's the video. No. This afternoon, oh boy. This afternoon, they had a nice picture of this, and now it's gone. All right, hold on a second. Well, we've got to have a million ads first. All right, hold on. I want you to see this because it's so cool. This is unbelievable. You know, sometimes finding stuff on the internet is really just like pulling teeth. It really is. Well, all right. Who is this guy right here? Standing right there, that bald guy. Who is that guy? That is Jeff Bezos getting ready to ride on this rocket, whatever they call it. The Blue Origin rocket. Okay, so apparently it goes out into space and comes right back. He's not going to the moon or anything, but still, he was on it. Okay, well, he started this thing, so therefore he gets to ride on it whenever he wants to. Okay, so that's Jeff. Jeff is having fun. So if you're really that crazy rich, there he goes. It used to be that rich people would show it off by building enormous mansions. Now they go into space, okay? Because Elon Musk apparently is next, and Richard Branson has already done this a little while back. This is the new Newport, let's say, for the ultra nouveau riche. This is what we do now. We go into space, okay? And that's how we be cool. Yep, there he goes. Bye, Jeffy. Ooh, they got to do that too, I guess. And then they came back. Wow, I wonder how much that cost him. I don't know, but I'm sure it was a pretty penny. Jesus. Okay. Well, anyway, enough of that fun stuff. So the market portfolio is, like I said, is a portfolio. Imagine that we took and bought every stock, and not just stocks. It's supposed to have everything, gold and currencies and you name it, all weighted by their market capitalization. So that Apple would probably be would have more. There would be more Apple than anything else in here. Now, the market portfolio doesn't really exist, of course not. So what we often do is use a proxy or substitute for it, which is usually the Standard & Poor's 500. The Standard & Poor's 500 contains the 500 largest stocks in the economy, weighted by their market capitalization. So it's a pretty good choice, although there are others that we could use as well. But this one seems to be the most popular. So the beta, the risk measure I mentioned earlier, the technical definition, and we don't have to worry about the stats here. Just want you to see this. The beta represents the covariance of the returns to a stock and the market portfolio divided by the variance or risk of the market portfolio. That's what we're actually calculating when we determine a stock's beta. Now, as it turns out, because of the way this beta was defined, the value of beta will be 0 for a risk-free asset like a treasury bill. The market portfolio, or Standard & Poor's 500, has a beta of 1 by definition. That's how the system is designed. So that when you come back here and look at Amazon and you see their beta is 1.15, that basically means that Amazon stock is about 15% riskier than the Standard & Poor's 500. Now, I don't know. It seems a little strange to me. I mean, Amazon is Amazon. It's going to get to the point, Jeff Bezos may, since he's now into rockets, maybe he'll just go ahead and buy the moon and build his new headquarters up there. It could happen. What would we call it then? I don't know. But that's what that number means. So you can think of it as, where do we stand compared to the overall market? Anything above 1 is somewhat riskier than the market. Anything below 1 is less risky. And 0 means there's no risk at all. So let's see if we can find a company that's not very risky, like Coca-Cola, for example. Their beta is 0.61. Now you can see why. I mean, really, what could go wrong at Coke? They have a very well-established brand name. I mean, are people really ever going to stop drinking Coke? Could a recession put them out of business? I don't think so. So their beta is quite low. But then maybe at the other extreme, let's try, how about Citicorp, which I think is just C. No, ooh, that's crude oil. No. Ooh, Citicorp is at 1.9. 90% higher than the average stock in the economy. Man. How about ExxonMobil? It's kind of fun to do this. I keep looking up betas. Oh, 1.42. I guess oil companies, by definition, are somewhat risky because you don't know what's going to happen. You don't know what might be discovered to take the place of oil. So their risk is getting up there, isn't it? Anyway, so the beta itself. Now, what's interesting about this model is that in the CAPM model, we're assuming that there's only 2 different kinds of risk. Okay, so let me just mention that right here. In the CAPM framework, we assume that there are only 2 types of risk: systematic and non-systematic. So what does this have to do with anything? What are we trying to say here? Well, systematic risk affects all assets in the economy, although not to the same degree. Examples are rising interest rates, slowing economic growth, changes in the value of the dollar. You name it, rising inflation. Clearly, these will have an effect. Or how about this one, rising oil prices? These will affect just about every asset in the economy. So we call this systematic risk. The risk, for example, that rates start to go up or that the economy slows down, the dollar starts to depreciate and our import prices are higher, inflation gets out of control, or maybe oil starts to become very expensive again. So systematic risk is that the type of risk that affects everybody, but not necessarily the same. And then non-systematic risk, as the name suggests, affects only a single asset or a small group of assets. For example, I'm trying to think of one that would be unique to a single stock. Or okay, let's think about this one. The risk that the next version of Windows is full of bugs is unique to Microsoft. Because realistically, if their next version is not working correctly, then they're the ones who will suffer for it, but very few other people will be affected by that. So that would be what we mean by non-systematic risk. Or it's possible non-systematic risk can also mean risk that applies to a single industry, especially like, for example, something that could cause an industry to become obsolete, like let's see, such as the risk that automation will eliminate
like video rentals.
Like what?
Video rentals was affected.
Oh, that would be the ultimate example. Like the risk that technology puts video rental stores out of business. Yes, of course, now remember, I think I mentioned this, there's still a single Blockbuster out there. So, but non-systematic risk means that all of a sudden the entire industry is gone because the technology changed. That's not going to affect anyone else. So the thrust of this is that the CAPM tells us that the returns to a share of stock or any other asset only depends on systematic risk. Okay, in other words, the returns to an asset depend only on how much systematic risk it contains. So that's why the beta matters, because in turn, the beta represents how much systematic risk an asset exposes investors to. Okay, so in other words, we're saying, well, all we have to worry about is systematic risk. Beta only measures systematic risk. As far as the non-systematic part goes, sorry. In a well-diversified portfolio, non-systematic risks will offset each other. So what we're saying in this discussion is that If you're worried about non-systematic risk, the way you can get rid of it is to not put all your money in a single stock, let's say, but have a very well diversified collection of stocks, so that if one sector isn't doing particularly well, you'll have other stocks in there that can make up for it. So in this theory, non-systematic risk should not be a problem for investors because they can get rid of it by holding a well-diversified portfolio. So the return to a stock doesn't depend on its non-systematic risk. On the other hand, the more systematic risk an asset contains, which is the same thing as saying the higher is its beta, the higher should be the return to that asset. So in other words, what the model is saying is that you might say, well, I don't want to buy a stock with a high beta because it's exposing me to a lot of systematic risk. But these are the very stocks that will tend to have the highest rates of return. So if you want to have a high rate of return, you really have to buy stocks that expose you to a significant amount of systematic risk. So the theory is based on the notion that we don't have to worry about non-systematic risk because we can get rid of it in a well-diversified portfolio. But with the systematic risk, the systematic risk can't be eliminated with diversification, but it does. But investors are compensated with higher returns by holding or bearing systematic risk. Okay, so that's what this model is all about. Now, there's several assumptions. In order to derive these results, the creators of this model had to make a lot of very strong assumptions, and you'll see that many of them are actually not very good at all. For example, now this one, it's not that terrible. Each investor is too small to affect securities prices with his or her own trades. All right, so there's nobody out there whose own trading could move the market, let's say. Now, of course, we know that's not the case. We know there's people who could do that, but let's just say that most people are relatively small investors. We all have an identical investment horizon. In other words, we're all looking to a certain point in the future. So when we buy stocks, for example, it's because we want to, let's say, retire at a certain point in the future. Now, here's a fun one. We can borrow or lend unlimited amounts at the risk-free rate of interest. Ooh, if only that was true. Wouldn't that be fun? Imagine if we could borrow $1 million at the treasury bill rate. Well, I think we'd all be borrowing our brains out, that's for sure. There are no taxes or transactions costs. So, boy, that's an unrealistic one. We all choose to be on the so-called efficient frontier. Let's explain that in a second. And investors have identical expectations. So the efficient frontier, what does that mean? Consists of stocks or other assets that have the lowest possible risk for a given rate of return. Okay, so in other words, if you can imagine, let's say we think about 8% as our rate of return. Whatever assets can give us that return with the lowest possible risk could be considered efficient. So the efficient frontier consists of all the stocks or assets that give us the lowest amount of risk for a given level of return. Now, if that's the case, you would never want to invest anywhere else, would you? No, I don't think so. Why would you? Okay, so that's where we all choose to invest. Now, the assumptions of the CAPM give us some very interesting results. Based on these assumptions, the implication is that all investors will choose to do the following. They will buy some combination of the market portfolio and the risk-free asset, by which I mean treasuries. Treasury securities. Now, that seems like a very strong result. But based on the assumptions of the model, that is actually how it would work out. So imagine every one of us says, listen, I'm going to do two things. I'm going to buy treasury bills and I'm going to buy the Standard & Poor's 500. Some people will buy more of one than the other, but we're all going to buy exactly two things. Sorry. And so that's all we have to decide, not what stocks to buy, but what percentage of our portfolio belongs in the S&P 500 and what percentage belongs in risk-free assets like the treasury securities. So anyway, all of this is building up to an equation which will show us, based on this CAPM framework, what the expected return to a stock will be. So let's take a look at these different terms and see what they're all about. So this little I, the subscript I means stock I. That's the expected return to stock I. This RF is the risk-free rate, which we can think of as the yield on a treasury bill. This is the stock's beta. And finally, this term is the expected return to the market portfolio. And all of that gives me my return. So the model predicts that if you know the risk-free rate, the return to the market, and the stock's beta, you can predict what the return of the stock will be. Now, you can actually draw a picture of this. Let me see if I've got one right here. Down here I do. All right. So in other words, if you look at this carefully, you'll see that if you put the expected return up here on the vertical axis and the beta on the horizontal axis, the intercept of this line is the risk-free rate. The slope is this gap between the return of the market and the risk-free rate, which is the market risk premium. And this line, by the way, is often called the security market line. And so the theory says that every stock in the economy is going to be on this line. So let's say here's a stock with a beta of 0.5. The expected return might be 6%. And over here, there's one, let's say with a beta of 1.5, and its return should be 12%. So all the stocks in the economy will fit right on this line, according to the CAPM model. And so you notice what's driving the returns is just that beta. The higher the beta, the higher will be the expected return to that stock. So that's what the implications are of this model. This is just a straight line. It's the equation of a straight line where the vertical axis is the expected return and the horizontal axis is the beta. And so this is the return to your stock. This is the risk. All right, so let's do some practicing with this. Suppose that we're told that the risk-free rate is 3%, meaning you could buy a treasury bill that yields 3%. Now, the risk premium of the market portfolio is this expression. Now, that tells me, though, that just the expected return to the market must be 10%, because when I subtract the risk-free rate, I get 7%. So this number tells me how much compensation do I receive for holding the market portfolio instead of a treasury bill. And here it happens to be 7%. So in other words, the compensation that you should expect to buy the Standard & Poor's 500 instead of the risk-free rate, meaning the treasury bill, is 7%. Now, if you own a stock with a high beta, the compensation will improve because the stock is even riskier than the market portfolio. If you have a low beta stock, then the compensation will be lower because you have a safer stock. All right, let's do some calculations. Now, I just made these up. These are not the right betas, but let's just say they are. Ford, IBM, GM, they have 3 different betas. And we're assuming, as it says here, the risk premium to the market portfolio is 7%, which is this entire expression. So that goes here. The risk-free rate is 3. The only thing that changes from one stock to the next is the beta. So with the Ford stock, with such a high beta, the expected return is 17.7%. Now, for IBM, whose beta is only 1.4, we would expect the return to be lower, and that's what it says here. 12.8% instead of 17.7. And then finally with General Motors, with a really low beta, the expected return is only 9.3% because, again, it's not nearly as risky as IBM and Ford. Now, the interesting part here is that if you plug this in to this formula, let me jump ahead a little bit here for you. There they are. And you can see the direct trade-off between all 3 of them. General Motors, the beta is 0.9 and the return is only 9.3%. IBM is at 1.4 and its return is up a little higher to 12.8%. And then finally, with such a high beta, Ford has a return of 17.7%. And you can see that the relationship between risk and return, according to this theory, is in fact a straight line. Well, now we do occasionally, though, find stocks that don't conform to this. What happens in those cases? Well, all right, let's say that we found a stock. The XYZ Corporation has the same beta as Ford, and yet for some reason, it's got a return of 20%. What happened? Both stocks are equally risky, and yet somehow XYZ has a higher expected return. That indicates that something's not right. What is wrong? Well, how can the return be so high? That's only going to happen if XYZ is underpriced. So what do you suppose investors will do? They'll buy it. The price rises and the return falls until it reaches the line again. So in other words, it'll just go right back down. I don't know if you can see that. It goes from here to here, let's say, just so you can see it, down to the line where it belongs. It won't go any further down, because once it hits the line, it is said to be correctly priced. Now, the gap between these two, the 0.2 minus 0.177, is referred to as the stock's alpha, or that's the Greek letter alpha. And so if you buy stocks and you earn alpha like this, that means you are beating the market. You are finding bargains. And in fact, on Wall Street, a lot of portfolio managers actually are compensated according to the alpha that they create. That means they bought stocks that ultimately proved to be undervalued. But it won't last long. So whoever gets there first gets most of the profits, don't they? Yes. It's like with a treasure map. Who gets to keep the treasure? Whoever gets there first. That's why it's a treasure map. Okay. If Jean Lafitte happened to leave a bunch of silver under your yard, well, that's yours. Okay. So maybe you should get a shovel someday and just see what's going on down there. You never know when old Jean might have been in your neighborhood on the run from the law. But anyway, what about the opposite case? What if I have ABC? Ooh, now what's going on here? ABC is equally risky as Ford, and yet somehow the return is only 16%. So this is equal to alpha 2, but here the alpha is negative. That means the stock is underperforming the market. We have negative alpha. Which means that it is overpriced. Now, how do you think investors will react to that? Investors sell the stock, the price falls, and the return rises. Until it was right back in the line again. Okay. So this is what will happen. It'll happen fairly quickly. So that way, if you own this stock, you'd want to dump it because it's too expensive. Now, if you're a portfolio manager, you're not too happy because you now have suffered negative alpha. But maybe you sold the stock before it goes down any further. Okay. So the CAPM model says that this will continue to happen automatically. Prices will adjust. Let's add this in here. So according to the CAPM model, any stock that is mispriced will adjust automatically due to the buying and selling of investors until it reaches the price that is consistent with its beta. Okay, it won't stay underpriced or overpriced for long. Investors will notice this. And so therefore, it won't stay off the line for long. Okay, now I mentioned this earlier. There's a few special cases. We can go through this one more time. The risk-free asset earns a risk-free rate of return and it has no risk. The beta is 0. For the CAPM, the market portfolio has a beta of 1, and then all the other assets in the economy, we can tell how risky they are. For example, we saw Coca-Cola is between 0 and 1, which means it's less risky than the overall market or the S&P 500. If the beta is exactly 1, then it has the same risk as the market portfolio. In other words, Standard & Poor's 500. And if the beta is greater than 1, it is more risky than the market portfolio. But remember, that might seem like bad news if the beta is greater than 1, but that means on average, the return should be greater than for the market portfolio. Okay, so like here, when we're doing these CAPM calculations, remember we said that the market risk premium was 7%, so that the return to the market was 10. Okay, so in other words, but then Ford with such a high beta is earning more than the market return of 10. IBM with a high beta, still not quite as high, has a return still greater than the market portfolio. And then finally with General Motors, whose beta is less than 1, the return is less than the market return of 10%. Very good. All right, now, let's just quickly look at what economic variables affect stock prices. These are interesting. Some of these are types of systematic risk and some are non-systematic. So what are we looking for here? Well, among all the factors that might affect a stock's price, economic factors, typically we mean macroeconomic factors like economic growth. Interest rates, the strength of the dollar, clearly those have to have an impact on the prices of most stocks, although not all to the same degree. For example, the strength of the dollar mainly affects multinationals that do business overseas. But growth, well, that pretty much affects everyone. And then interest rates, well, that depends on the degree to which your corporation needs to borrow to finance its operations. And some institutions make money from higher interest rates, like banks, for example. So banks might find themselves benefiting from rising rates. Growth refers specifically to GDP, gross domestic product, which measures the dollar value of all the final goods and services produced within the borders of a country during a given year. At the moment, US GDP is approximately 20, maybe $21 trillion. That's not bad. The next closest is China. They're at about 14 trillion. And I think Japan might be third at about 5 trillion. So the US by far has the largest economy, but we don't necessarily have the highest growth rates. Okay, that's just the way it is. I mean, the larger the economy, the harder it is to grow fast. So while we have the most total output, the growth rate is typically higher in countries like China and India. So as GDP grows, society as a whole becomes more affluent and they can afford to buy more goodies. And so corporate sales will grow and stock prices will likely rise. You know how it is. The more money you have, the more things you want. Okay. Now, of course, during a recession, the opposite happens. GDP growth slows, it becomes negative, and people buy less products, and profits tend to fall. Interest rates. Now, interest rates directly impact the cost of borrowing. Most corporations have to borrow a lot of money to run their businesses. By the issuance of bonds, that is. They may go to banks, but a lot of their funds are raised by issuing bonds. Sure, stocks too, but stocks only involve sharing the profits with the shareholders. This is different. This is borrowing. A corporation that issues bonds is actually borrowing directly from the public in exchange for a payment of interest. So higher interest rates means higher cost of borrowing, and that eats into the corporation's profits, which in turn lowers stock prices. All right. The dollar, that mainly affects companies that do business overseas, but no, not necessarily, because other companies might use imported products to produce their products. So, like say, for example, Apple. When you buy an iPhone or iPad, a lot of the parts that are in that phone or computer or iPad or whatever the case may be were probably not taken from the United States. Apple was able to find them cheaper in other parts of the world. So the strength of the dollar affects the cost of buying these foreign products as inputs into our own products. So if I'm Apple, and most of the inputs into my iPads are coming from foreign countries, I want the dollar to be as strong as possible, because a weaker dollar means import prices are higher. But every company may be affected a little differently by the strength of the dollar. It depends on whether they're buying foreign products or selling foreign products. So this can have an impact on just about every company, but it could be very different from one company to the next. All right, let's see. How about market factors? This is really more about market psychology. Optimism, pessimism, confidence, these are all things that will drive people to buy or sell stocks. Like we saw yesterday, the Dow dropped by about 900 points, and today it bounced back by about, I think, 600 points. How does this happen? Well, because one day people start to get pessimistic. They start selling stocks like crazy. Oh boy, it lost a lot of the rally here. It only ended up at 64, but oh no, that's not right. Those are Dow futures. The market bounced back pretty well today. So people change their minds. They become optimistic, they become pessimistic, and that will heavily influence their decisions as to what stocks to buy and which ones to sell. So obviously, if we become more pessimistic, stock prices tend to fall. And as we become more optimistic, they tend to rise. Of course they do. Now, you also get these weird effects too, like the January effect. You've probably heard about it. Most stocks actually go up in January. It's pretty strange. There's something about January that makes the stocks go up. Now, I don't know if it's a strong enough effect that you can make money on it. But what tends to happen, according to the book, managers feel free to take more risks in January than in December because they're judged on how the entire year went. In January, if they slip up, there's time to make up for it. Not so much in December. So managers can take chances in January when they can't really do that in December. And then finally, there's factors that are these are basically the non-systematic factors that affect only specific companies. All right. And then, of course, taxes. Taxes are everywhere. They definitely have an influence on stocks because, as you may know, if you hold a stock for at least 1 year and sell it at a profit, the tax rate is not your own personal tax rate, but the capital gains tax rate, which is often lower than personal tax rates. Although it depends, it changes. The government can't stop fooling with it, But when capital gains taxes are relatively low, that tends to give strength to the stock market and vice versa. All right, that's enough of that. Now let's switch our attention to the first of our discussions about derivative securities, which are primarily hedging instruments, which means they're designed to reduce risk. Okay, so the first and simplest of the derivatives are forward and futures contracts. So let's start by noting that a derivative security is a financial asset whose value is derived from an underlying security such as a stock or a bond. And in fact, that's where the name comes from. Derived from other assets. It's a derivative. It's not really unlike derivatives in calculus in that regard. It's based on some underlying security, and the underlying asset can be almost anything you can imagine. You can buy derivative securities where the underlying asset is interest rates or stocks or bonds or gold or silver or oil, you name it. There's a derivative out there somewhere whose value depends on it. And believe it or not, sometimes the underlying asset might not even be an asset. It could be something as wacky as the temperature or the snowfall. It is actually possible to buy derivatives whose value depends on temperature or rain or snow. They do exist. Now, derivatives, unlike stocks are traded through exchanges, as we saw. Derivatives can be traded through exchanges, or they can be negotiated directly between counterparties. Now, what kind of exchanges would carry derivatives? Well, they're specialized exchanges. One of the most famous ones is the Chicago Mercantile Exchange. And if you need one of these derivatives, this is one of the most, probably one of the first places you'll check to see if they have what you need. It's big. It's enormous. Now, we have a few others, of course. We have the New York Mercantile Exchange, which I think it only does energy derivatives. I'd have to check that out. We also have the London International Financial Futures Exchange, and there's many others throughout the world. Now, interestingly enough, just as a side note, the Philadelphia Stock Exchange actually deals in currency derivatives. And as far as I know, that's all that they have. I don't know how that happened, but they do. And there's plenty of others scattered throughout the world. Now, if we don't go to an exchange, we can go to the so-called over-the-counter market, where the derivatives can actually be customized for our purposes. This is where it gets really interesting. The ones that are available on these exchanges are standardized products. There's only so many that they have, and you have to pick one of them. This is where they can be customized. So if your needs are a little out of the ordinary, like let's say you do a lot of business in Peru, and you need to hedge against the risk that the Peruvian dollar gets weaker. Well, you're not going to find that on the exchanges because it's just too small of a country. But you can go to the market, the over-the-counter market, and find a Latin American bank that will create a product for you, and now you're all set. Anyway, what are the basic types of derivatives that we can buy and sell in the US and around the world? Well, the first two, as we're doing tonight, are forwards and futures. We also have swaps, and we have options. Now, some of these have been around for a long time, and some of them not so much. Swaps have realistically only been trading in the US since the early 80s. Options have been trading since the early 70s, but forwards and futures have been around quite a long time. Certainly at least since the 19th century. They're very simple. In fact, now interestingly enough, initially these contracts were written on agricultural products like corn and wheat and hog bellies and all this and that. Because in the 19th century, what business did most people work in? Farming, yes. Not anymore. I don't even know what percentage. Let me check this out. I'm going to go with 2%. What percentage of Americans work in farming? No, 10.9%. Oh my God. Well, you know what? Maybe they've got a lot of people doing things like driving trucks and things that aren't really farming jobs as such. I don't know. That sounds kind of high. But certainly, see if we can find this one. Oh my God. In 1850, farming made up 64% of the jobs. In 1920, it was 32%. Now it's around 10.9. So why is this happening? Because agriculture is so efficient. But these contracts were very helpful to farmers. As you can imagine, I mean, farming is a very risky business. You plant your crops, let's say in the spring, and you harvest them in the fall. And when you harvest them, or when you planted them, you had no idea what they'd be selling for in the fall. So in order to hedge the risk that the prices might drop, you can enter into one of these contracts. Okay. So let's start with the forward contracts. A forward contract is a very simple idea. It's an agreement to buy or sell an asset at a specific date in the future, but the key detail is that the price is agreed on today. So you can imagine in the 1850s, a farmer could say, well, I want to sell wheat, 100,000 bushels of wheat in September for X dollars a bushel. And so you'd enter into a contract with a bank, let's say, and in the fall, it doesn't matter anymore what the price of the wheat is, your contract specifies how much you receive for each bushel. Now, of course, we have financial derivatives. So a very popular type of forward contract is a foreign exchange forward contract. So let's say the spot exchange rate between the dollar and the pound is 169.80 per pound. But I can enter into a 6-month forward contract to buy those pounds for 167.15. So this first one, this is the price at which I could buy pounds for immediate delivery. It's called the spot exchange rate. This is known as the forward. Exchange rate, specifically because it's due to be delivered in 6 months. It's known as the 6-month forward exchange rate. I can enter into a contract right now and agree to buy as many pounds as I need in 6 months for $1.67.15 each. It's a binding agreement. It's legally binding. And so why am I doing this, by the way? What would be the point of entering into this contract? Well, here's an idea. Suppose that a U.S. importer needs to buy, say, 10,000 pounds in 6 months. He's worried that the exchange rate will rise by then, leading to or making the pounds more expensive. by entering into the contract, the importer is guaranteeing that he will pay. So we multiply these together. Yes, so we just literally just multiply them together. And the total cost is guaranteed to be, let's multiply those out. 10,000 times 1.6715 is $16,715. No matter what the spot exchange rate is, spot exchange rate is in 6 months. He doesn't care. He's going to pay that amount regardless. So all of the risk is gone. So he doesn't have to worry about a thing now. Now, there is one potential drawback, though. What if the price drops? So, in other words, this has the advantage of locking in a price which will be paid for the pounds. The price can't rise any further, but it also can't fall. So in other words, if you go into the marketplace in 6 months and pounds are only selling for $1.60, well, we can't really take advantage of that because we're committed to paying $1.6715 each. So, it's kind of like an insurance policy. If you buy insurance and you never need it, are you upset that you paid all that money to the insurance company? Probably not, because you know what? All that time you were actually protected. But here it's the same thing. If we lock in a price, we may realize that, well, if we'd waited, we could have saved a little money, but that would have meant also having all that risk, which we simply do not want. Now, this is something you may have noticed, by the way, when you go to a foreign country and you need currencies. Let's say you're traveling to London on business and you say to yourself, ooh, I should probably have some pounds in my pocket. You go to the dealer in the airport, Thomas Cook, let's say, and you notice there's 2 numbers there. And you're looking at it and thinking, why? Why are there 2 numbers? The lower of the 2 is the so-called bid price. The upper is the so-called ask price. Now, the way this works is that the dealer has to make money. So you will pay the higher price when you buy the pounds, and you'll receive the lower price when you sell the pounds. Well, but of course, keep in mind, they're doing you a favor. They're offering you a service, and this is how you pay for it, by giving them a slightly higher price when you buy and receiving a slightly lower price when you sell. So they're not taking advantage of you. This is how they make their money. Okay. That's how it's done in any dealer market. This is true for stocks as well. There's a bid and there's an ask price. So any quotes you might see, let's say on a website like Bloomberg, let's take a look for a second. Bloomberg currencies, let's see what the exchange rate is today for the dollar and the pound. Oh, it's only 136.34. That number is the midpoint of the bid and the ask spread. You can't buy or sell at that price. The actual price at which you'll buy will be a little higher, and the actual price at which you'll sell will be a little bit lower. So, just be aware. But I mean, like I said, if you've ever traveled, you noticed this probably when you looked at the quotes and you thought, oh, there's two numbers for each one of them. This is why. All right. So let's jump ahead a little bit. Forward contracts are traded in the over-the-counter market, which means that they can be customized. So what does that even mean? So the buyer of a forward contract can specify the asset being purchased, the number of units of the asset being purchased, and the time at which the assets will be delivered. So we have complete control over that. The only thing is whoever's selling us this contract has to agree to it. That's it. That's the holdup. We have to agree with somebody else. This is what we are going to do. So, but this is, like I said, if you need, let's say, some obscure currency that doesn't trade very often, or if you need a peculiar amount, like 84,000 units, or if they need to be delivered at some oddball time, like February the 3rd, or, something that's not standardized, then you can do this through a forward contract. In principle, you can buy or sell anything through a forward contract. It doesn't really matter what it is. As long as there's two sides who agree to this, then you're all set. So let's say you have a hankering for ostrich eggs, but the stores are constantly running out of them. You can enter into a contract with the ostrich farmer and say, listen, farmer, I need you to sell me 100 eggs every quarter at this price, and you're all set. I don't know what made me think of that. If you've ever seen an ostrich egg, it's enormous. There must be the equivalent of 20 chicken eggs in there. It's gigantic, beyond belief gigantic. In fact, let's ask Google this question. $24. I figured it was something in that neighborhood. Wow. I guess if you're making just a massive omelet, that might save you a little time. You only have to crack open one egg instead of 24. All right. Anyway, so if you're buying an asset through a forward contract, you're said to have a long position. And if you're selling, you're said to have a short position. So for every long, there has to be a short, of course. Now, how exactly would you hedge with a forward contract in the foreign exchange markets, at least? All right. Well, this is, like I said, this is the most common use of these contracts. So, before we do that, let's take a detour and look at the following discussion about the strength of the dollar compared to a foreign currency. Suppose that you discover that the current spot exchange rate is $1.30 a pound. And the next day that goes up to $1.35 a pound. Which currency became stronger and which became weaker? Good question. Well, here's the logic. It now takes more dollars to buy a single pound, which means the dollar got weaker, but that means the pound got stronger. So the official terminology there is that the dollar has depreciated against the pound, which means in turn, the pound must have appreciated against the dollar. So when the exchange rate changes, one currency strengthens and the other weakens. We call the strengthening an appreciation and the weakening a depreciation. Okay. Well, So now a U.S. importer will need to buy 100,000 pounds of British goods in 6 months. The problem that he faces is that the cost could go up, which means the dollar got weaker. What does he do about it? He can wait and hope for the best, or he can enter into a forward contract to buy the pounds in advance, or at least lock in the price today. So if we use that same example, if he waits and doesn't do anything, and the exchange rate goes from 130 to 135, the cost of buying these pounds will go from 130,000 to 135,000. That's going to cost us more money, $5,000 more dollars. That hurts. That's going to reduce our profits. Now, of course, it could go both ways. Of course, the dollar could get stronger. Let's say the exchange rate drops from $1.30 to $1.25. The cost of buying that 100,000 pounds will actually fall by $5,000. But you know what? We don't want to take any chances. We're not in the business of speculating on currencies. So what do? We enter into a forward contract to buy the pounds in 6 months at a price that's settled on today. So let's say that they agree with the counterparty to buy the pounds in 6 months for $1.32 per pound. So we're locking in the purchase price of $132,000, and that will hold no matter what's going on in the market at that time. So it's kind of like an insurance policy. Now, here's another example. Suppose that we enter into a forward contract to pay $1.70 per pound for a future delivery of 100,000 pounds. Now, if you look at this graph, you'll notice something interesting. This is the so-called hedged position. We're guaranteed to pay $170,000 with our contract, no matter what's happening in the market down here on the bottom. This is the spot exchange rate in 6 months. On the vertical axis is the cost of buying 100,000 pounds. So this is locked in. If we don't hedge our risk, so this is it, we're done. Nothing else to worry about. If we don't hedge our risk, this upward sloping line represents the cost of buying the pounds. And you can see at $1.70, well, we've broken even. At $1.60, we've saved a bunch of money. But at $1.80, we've lost a bunch of money. So if you don't hedge, you're basically taking a lot of risk. If you do hedge, you've eliminated all of your risk. Okay. Now, by the way, this is from the position of a buyer. You can also be the seller. And then what you're doing is you're hedging against the possibility that the exchange rate goes down and you're selling at a lower price. So you can do anything you want with a forward contract. It's easy to enter into, it's easy to get out of it, and it's easy to hedge your risk, and there's no cost involved. You don't have to pay to do this. There might be some fees or something, but basically it's free. Now, in the marketplace, there's also available to us something called a futures contract, and the name tells us that it's very similar to a forward contract. Because again, it gives us the idea that we're locking in the price at which we can do something in the future. So the differences between these two contracts are more institutional. The basic logic is exactly the same. But there are some key differences. First, as we've already seen, forward contracts are negotiated directly between counterparties, which means that they're flexible. A forward futures contract can only be bought on an exchange, like the Chicago Mercantile Exchange, which means that you can only take whatever contracts they have. There's no flexibility. You take what they have or you don't take anything. Now, because the forward contract is negotiated with a counterparty, there's always some credit or default risk. Okay, so for example, what if I bought one of these from Lehman Brothers? I guess it would have been in the spring of 2009, maybe. What happens when Lehman Brothers goes out of business? There goes my contract. And that could lead me to significant losses. The futures contract, there's no risk because it is guaranteed by the exchange in which it performs. And the exchange is not going to go out of business. In fact, the members of the exchange put up money that the exchange can use in case it runs into trouble. Now, a futures contract is easy to unwind or get out of by taking the opposite position. With a forward contract, pretty much you're stuck with the contract if you enter into it. It's not impossible to get out of it, but it's much more difficult than with a futures contract. All right, and then finally, we have this, with forward contract, you enter into it on the maturity date, you pay for your pounds or you receive money for your pounds. With a futures contract, it's very different because we might have daily cash flows throughout the life of the contract. Because you will have to put collateral up when you enter into a futures contract, and the value of your collateral can change every day. So let me show you a quick example of this. Oh, actually, I'll tell you what, I just didn't realize it was so late. Why don't we save this example for after the break? We're actually getting through this pretty quickly. I think when we were finished here, we'll wrap up the futures and then we'll start the options because they're very complex, but they're also very, very interesting. I think you'll agree with me. So, all right, let's stop it here and we'll have our break. When we get back, I'll walk you through this example with marking to market. And then when that's over, we can start looking at options. All right, let's knock it off for a bit. Okay. Okay. So what's going on with this last part? So here's a situation. Chicago Mercantile Exchange futures contract on gold requires an initial margin of $5,500. That's the collateral you have to put up. They also have something called maintenance margin of $5,000. So what that means is you deposit $5,500 with the exchange when you enter into the contract. Now the contract is written on 100 ounces of gold. That's standard for the CME. So every time the price of gold goes up by $1, you make $100 on your position. But if the price goes down by $1, of course, you lose $100. And you can see that, if gold has a rough day, your position could be wiped out pretty quickly. So let's just say that it goes down $10, which means that the value of your position has lost $1,000, which brings your margin balance all the way down to $4,500. Now, that's upsetting enough as it is, but that means that your balance has fallen below the so-called maintenance margin, and now you have to put more margin into that account. What you have to do is bring it back to the initial level of $5,500. So that means you will owe them $1,000, or you must deposit another $1,000, and that is known as a margin call. If you don't, or if you can't, then they will simply close out your account. Okay. Now, you'll still get your $4,500 back, but your position is wiped out because you couldn't afford to cover the margin. Now, this kind of thing would never happen with a forward contract because we don't have this marking to market requirement. So this is one of the awkward things about futures contracts, the margin requirement. But this is done to protect the exchange from suffering large losses if your position deteriorates very badly and you can't cover your losses. So in other words, they don't want to cover your losses for you. So they've essentially set up the system to ensure that if your losses start to pile up, they can stop it from getting any worse by having this margin requirement. Anyway, so now, and also I went ahead and looked at the Chicago Mercantile Exchange. I looked up their contract on the British pound, their British pound futures contract, just so you can see the exact details. So what you're seeing here is that each contract is for 62,500 pounds. You can trade it between Sunday and Friday from 6 p.m. to 5 p.m. The minimum price fluctuation is 1.0001 US dollar per British pound, which works out to $6.25 per dollar. These are the details about the product code. And the delivery months are March, June, September, and December. So if I want to buy British pounds for delivery in March, June, September, or December, I can certainly have that. But if I don't want one of those months, then I'm kind of out of luck. So this is what I meant before by saying you've got to take what they have. Or let's say I don't need 62,500 British pounds. Let's say I only need to hedge a risk of 10,000 British pounds. Then this is not the right way to go. I'll probably be better off getting into a forward contract where I can specify what I need, whereas here I just have to take whatever's available. So, for some hedgers, forward contracts make more sense, and for some, futures make more sense. So every hedger has to make sure they understand how these are different before they make a decision which security to use. All right. So anyway, I think it's time to go ahead now and look at options. Now, options are a lot of fun. It's a very interesting area of study. And the name kind of suggests to us what they're all about. All right, so let's get this out of here. Let me go open that up. I still can't believe that there's that many farmers in the US, but it just seems too high. Have you ever met a farmer? Not me. But I guess they all live in Iowa anyway, so what's the big deal? All right, well, anyway, let's go back. Oh, that was chapter 11. Okay. Let me just make sure that gets saved. So chapter 14, which is our last chapter, is our discussion about options. And let's get that open. Okay, here we go. Now, an option is another type of derivative security, but it has some interesting features that you do not see with forwards and futures. In particular, unlike a forward or futures contract, which is giving you the legal obligation to buy or sell an underlying security, with an option, you don't have an obligation, you have a right. A right to either buy or sell an underlying asset at a price agreed on today, but not the obligation, which means you can change your mind. And that's a very valuable thing to be able to do, as we'll see. Now, how do you characterize an option? Well, each option has several key features that we need to know. First of all, what asset is it giving us the right to buy or sell? Now, it turns out options are available on many, many different kinds of assets. Here's a short list. For example, you can buy options written on interest rates, currencies, equities, in other words, individual stock options, equity indexes like the Standard & Poor's 500, precious metals like gold and silver and platinum and palladium. And then, believe it or not, you can buy an option on a futures contract. And those are called futures options. Okay, now, by the way, now that we're mentioning precious metals, let's just check this out for a second. I think at this point in time, platinum is more expensive than gold or palladium. Yeah, here we go. Platinum. Ooh, maybe not. No, platinum is cheaper than gold right now. So I must have been thinking of palladium. Oh, there we go. Ooh, palladium. That's even more money than gold. So platinum and palladium are white metals. I don't know if you've ever seen them. Sometimes rings and other jewelry are made out of platinum, but not so much. I think palladium is more likely to be used for industrial purposes. Ooh, look at that. 0.9995 platinum. Ooh, doesn't that have that nice gleam? How'd you like to have a few of those in your safety deposit box? Ooh. And then palladium. Yeah, you see, they don't have these beautiful, oh, there they are. Here's a bar, 10 ounces of palladium. Atomic symbol PD, I see. Does everyone remember the periodic table of the elements? That's right. Some of them are quite surprising. For example, you might recall that the atomic symbol for gold is AU, if you can believe it, and silver is AG, if I remember correctly. PD for palladium, platinum, I'm not sure, but, oh, no, that's the palladium. So, ooh, there we go. These lovely bars of palladium, fine palladium, 9995 pure. Ooh, you can only dream, can't you? Imagine yourself rolling around in all these bars of palladium. If you were insanely rich, you could do that if you wanted to. That might be fun. But anyway, so options are available on everything. You can buy an option on palladium and platinum and gold and silver, you name it. You can buy it on the British pound. You can buy it on individual stocks. Now, the price at which you're allowed to buy or sell is called the strike or exercise price. I'm not sure why, but that's what they're called. The maturity is the time until the option expires. It has a specific length of time within which you can buy or sell the asset, after which it simply expires. Now, the two basic styles of options you'll see in the marketplace are the ones that give you the right to buy. These are known as call options. And the ones that give you the right to buy or sell are called put options. So buying is call, selling is put. All right. So if you want to buy something, you buy a call option. If you want to sell something, you enter into or you buy a put option. So the call is equivalent to a long forward position, and a put is equivalent to a short forward position. And finally, the other way in which we can classify options is most options in the marketplace are either European style or American style. European style means you have to wait till the expiration date to make up your mind if you want to exercise it or not. American style means every day that goes by, you can decide, yes, I want to exercise, or no, I don't, up until the expiration date. Now, I'm going to show you some actual option prices. So let's go back to our old friend finance.yahoo.com and let's look at Apple. Now, if you look at this website, way over here, it shows options. And these are actual options that traded today on Apple stock. So what do we notice here? First of all, they all have an expiration date of July 23rd, which is Friday, I believe. Yeah, Friday. And you'll notice on top we have calls. And then after this huge list of calls, we have puts. Now, what else do we see here? In this column, we have the strike price. So this option gives me the right to buy Apple stock for $75. That's a valuable option because the stock is actually selling for $146.15. But because of that, the price of this option is very high. It would cost me $71.20 to buy this option. Let's look at a more reasonable one. Let's try this one, 146. That one will only cost me $1.54 because the price of the option is only slightly higher than $1.46. So the strike price is a major determinant of the cost of this option. Now down here with the puts, these are the ones that give me the right to sell the option. So these low strike puts are not very valuable. The right to buy, for example, sell Apple for 75 is very low. But if we move up here, for example, the right to sell it for 160 is very high. That's going to cost me $13.90 because I'm selling it at a price that's higher than the market price. All right. So now, unfortunately, option prices for other securities are usually very hard to find on the internet. Usually you end up having to pay for them. They're proprietary. So unlike stock prices where we can get them very easily, I can't, for example, look up gold option prices, or at least I don't think I can. Let's give it a shot. Oh, wait a minute. CME may have some prices for us. Ooh, I was mistaken. So for August 21, By the way, when you see this on an exchange, it typically means the third Wednesday in that month. It doesn't have to, but that's pretty standard. The range of strikes is right here. This is gold now. So the one that has a strike of 1785, the call price is $30.10. The put price looks like it's $3.70. Okay, or actually, no, you know what it is? I just realized this is the day before's settlement price. That's where it closed. The last traded price for this put is $3.90. There's none over here for, okay, so you know what that might mean? It means that nobody bought this option today. Here's one that did trade with a strike of 1820. It looks like somebody paid $7.30 for this option. Okay, the right to buy gold for $1,820 was selling for $730. So, see, the one thing about these options, though, is that many of them do not trade very frequently. So it's not always easy to find good market data. Not so for stocks. Stocks, everybody loves stocks, and they'll buy options and futures and everything else. Gold, maybe not so much. Okay, so we have all these other months to choose from. But, and also what we can do, that was just at the money. These, okay, this is the full list. But this includes the ones that are really ridiculously cheap or expensive that probably nobody is buying or selling. Yeah, that's what I thought. All right, well, anyway, now, what happens if you buy a call? All right, let's, I'll tell you what, let's back up for a bit and come up with an example. All right, so suppose that the price of gold is $1,700 per ounce. An investor buys a call option on gold with a strike price, let's say $1,700 per ounce. The option expires on September 1st, and the price of the option is $20. So this is the scenario. The price, let's say the spot price of the gold, the current price is $1,700, and we buy call with a strike of $1,700. It expires on September 1st. We pay $20 for that option. So in September, there's really only two things that can happen. Either the price of the gold goes up or it goes down. If the price of the gold rises to $1,800 per ounce on September 1st, the investor will exercise the option to buy the gold for $1,700 per ounce. Now, he can then sell it in the market for $1,800 per ounce. So we say here that the payoff is $100. In other words, 1,800 minus 1,700 is 100. So in other words, my reward for buying this option is that I get to pay $1,700 for something that's worth 1,800. On the other hand, what if the price falls to 1,600? Now, here's the question. will the investor use his option to buy gold for $1,700 an ounce? And the answer is no. Why would he pay $1,700 per ounce when it's only selling for $1,600? So the investor will not exercise the option. He can buy the gold in the market for only $1,600. Therefore, the payoff to the option is zero. So two things can happen. Just in general, if the price of the gold rises above the strike price, the payoff will equal the spot price minus the strike price, which we can write as S minus X. Okay, S minus X, where S is the spot price and X is the strike price. If the price of the gold falls below the strike price, the payoff simply equals zero. So we're going to consolidate those into an equation, basically. We're going to say that the payoff is the greater, max is simply maximum, of S minus X, which of course happens this is only true if S is greater than X, and this is true if S is less than or equal to X. Okay, so in other words, remember our first example, the price went up to 1,800. And so we made a payoff of 100. In the second example, the price dropped to 16. And so it's not negative 100, it's just zero, because we will not exercise the option. All right. What about the profits, though? Now, remember, here's one thing we did not take into account. What about the $20 that we paid for the option? What happens with that? Well, like an insurance policy, you have to pay that whether you use it or not. So in the first case, the payoff was $100 with a price of 20, the profit is $80. In the second case, the payoff was zero with an option price of 20. The profit is actually a loss of $20. So we can turn this into a formula as follows. The profit or loss to the buyer of the call option is the maximum of S minus X, comma 0, minus C, where C is the price of the call. Okay, so that's the profit or loss. So we have the payoff first minus the price of the call equals the profit or loss. All right, so that's how that works. So we have a payoff, which now, by the way, here's the one thing I just wanted to point out to you. And this is one of the interesting things about options. The payoff to the buyer of the call option can never be negative. The loss to the buyer of the option can never exceed the cost of the option. Aha. So those are two very important ideas. And so when you bring all this together, it turns out, and this is so important for options, this is why they're more valuable than other types of derivatives. The call option and other options too, but has a limited or maximum possible loss and a no maximum possible profit. Now, where else do you find that in the marketplace? There's a limit to how much we can lose, which is limited to how much we paid for it, but there's no maximum profit. Wow, now that's a very powerful position to be in. So what that means, though, is that unlike a forward contract or a futures contract, an investor must pay a premium to buy an option. Okay, so the forward contract is just an agreement. You just agree to do something. The futures contract has a margin requirement, but that's just collateral. You get that money back if you don't lose it. This is the first derivative that we've seen where you actually have to pay for it. And that makes it a little different. Now, figuring out the appropriate price of an option, that's where all the rocket science gets involved. That's where all the math shows up. But for our purposes, we can understand the basic features of these options without bothering with the math, as long as we understand how they're structured and how their payoffs and profits and losses are determined. So what we're going to do is see a bunch of examples, more examples with calls, and then we're going to turn our attention to puts. And what we'll discover is that we can actually use these positions to not only hedge risk, to not only speculate and make money if we're right about the future direction of an asset, we can also turn them into very complex trading strategies, which cannot be carried out with any other types of derivatives. Okay, so this is where we're going. Now, it sounds like it's going to be very complicated, and it kind of is, but it's an extremely important topic. And so anyway, so in the meantime, since it's getting kind of late and this is a very complex topic, I think we've gotten quite enough done for one night. So just remember, try to have your problem sets and your midterms ready by next week. And then this, I will convert it into a project of some kind in Excel, and that will serve as our final exam. And then we're done. And so next week we'll wrap up this chapter, and that will be it for the new content. So anyway, so if you have no last minute questions, I guess we can kind of cut out here and do something else for a while. All right. So I'll see you all next week then.
Okay. Bye, Professor. Good night.
Bye.
Thank you so much. Have a good night.
All right. Bye.
Thank you, Professor.
See you later.